Here with Kain Warwick, founder of Synthetix. Nice to meet you, Kain.
Yeah, thanks for having me.
Yeah. Can you just give a brief overview? How'd you get into crypto?
How did I get into crypto? I was running a payment startup. Basically, it allowed people to put cash into local businesses and get money into like online services.
Is this like before crypto was even?
No, this is like 2014, 2015.
So pre-Ethereum, but Bitcoin.
Yeah, around the time Ethereum was launching. Yeah.
Okay.
I think we went live like early 2015.
Cool.
But started working on the project in like 2014. There were a whole bunch of use cases for this, right? Like people who had cash, were paid in cash or whatever, didn't want to put cash into the bank to then use a credit card to pay for a service. They just wanted to like directly pay cash into an app, for example.
Yeah.
And so I was friends with Asher from CoinJar, which is one of the like early Bitcoin payment services and brokerages in Australia. So this is back when I was in Sydney. I called him up and I was like, hey, I think this would be really good for you guys, because back then the banks were very adversarial. So their bank accounts would get shut down all the time.
Yeah.
When people were doing wire transfers and stuff, and the banks would detect their wire transfers, they'd work out that it was a crypto company and they'd shut the account down.
I mean, that was even going on in 2019.
I know,
still.
it's crazy. Yeah. So, in Australia it was pretty bad. And so this was a way for them to kind of route around that. And so they started using it, bitcoin.com.au, a bunch of the exchanges in Australia started using the service. So that was kind of how I, really went down the rabbit hole.
Cool.
Yeah.
Cool. Yeah. Can you tell us a little bit about Synthetix? Just kind of a brief overview. We can touch on it more later.
Sure. So basically, Synthetix is a crypto collateralized stablecoin, except instead of having a single stablecoin like DAI, for example, that's collateralized by ETH, we've got a suite of stablecoins. So we've got USD, we've got an ETH stablecoin, BTC. So these are all tokens that track the price of a range of different assets: gold, silver, etc.
Okay, so that's a synthetic component.
Yes,
they're
exactly.
tracking it.
Yeah, so like they're synths, right? So each synth just tracks the price of a specific asset.
Oh, so is that a derivative also, or is that?
Yeah,
like...
it's kind of a derivative. Yeah.
Okay.
Yeah.
Very cool.
Yeah.
Yeah. Moving on, I guess, can you kind of give a brief overview of what a synthetic asset actually is? Like, we touched on it earlier, like it's something that, I mean, if I have a synthetic dollar, it's not a dollar, but it tracks the price of a dollar.
Yeah,
how does
exactly.
that work?
I mean, what you want is, the purpose of like what a synth actually gives you, like what is the value prop of a synth, is that if you want to have exposure to Bitcoin on Ethereum, you have a couple of different options. You could construct some kind of swap-like contract, right? Like a counterparty-based swap, where you have exposure to effectively one Bitcoin worth of price volatility, for example. You could also wrap a Bitcoin on the Bitcoin blockchain, like what wrap BTC does, WBTC does, and have a custodian store it for you, right? And then you get like an IOU token on the Ethereum blockchain, right? You could, there's a couple of other different ways, bridges and things like that, right? But these are all ways that people are kind of constructing a tokenized representation of a Bitcoin on Ethereum. Why do they want to do that? Because Ethereum is where the DEXs are, it's where the aggregators are, it's where all of the activity is, and people want exposure to Bitcoin, they want to be able to trade Bitcoin, but they want to be able to do it on chain, and so they need a way to kind of bring that onto the Ethereum blockchain. So the way that we do it is we use oracles from Chainlink to basically publish a price of Bitcoin, and then we have this mechanism that kind of ensures that the price of SBTC, which is synthetic Bitcoin, tracks the price of this Bitcoin via the oracle.
And you said it's collateralized, right? What's the collateral there?
So there's a range of collateral. There's LUSD, stablecoin, but the primary collateral is SNX. So SNX is the Synthetix token. Okay. So people lock SNX into an over-collateralized debt position in order to issue SUSD, which can then be converted into any of the other synths.
Okay, so over collateralized. There's more SNX locked
There's more
behind
value.
every. Okay,
Exactly. Yeah. Yeah.
cool.
Yeah.
Yeah, and there are liquidations if SNX
Liquidations,
drops, or...
yeah, exactly, yeah.
Okay.
So, like any other kind of over-collateralized stablecoin or, or lending protocol where you're borrowing against collateral, there's a bunch of mechanisms that kind of keep things in check and keep them in equilibrium.
Very cool. Cool. So, besides these synthetic assets or this stable coin, is there any other areas Synthetix is expanding on? I know you guys are, recently heard something about atomic swaps.
Yeah.
How does that go into everything? I hear atomic swaps a lot. I don't know exactly what they are.
Right.
If you could start with that,
Yeah.
and then kind of explain how you guys are dealing with that.
I think it's kind of a marketing term more than anything, right?
Okay.
So like the atomic part is really, I guess, talking about the fact that it happens in a single transaction, right? So like it's an atomic, it's a whole bunch of things that are all wrapped up into a single transaction.
Kind of like
right?
how flash loans work. It
Exactly,
all goes
yeah.
through, it all doesn't.
It's an atomic transaction. So the whole flow of the transaction happens in a single block, right? In a single transaction, and that process leverages a whole bunch of protocols. So it leverages 1inch, the 1inch router, it leverages Curve, it leverages Synthetix, and what most of these transactions are doing is like arbitrage. On-chain and off-chain arbitrage. But because with Synthetix, you have this deep liquidity between synths, you've got two different curve pools, one that has synthetic USD and one that has synthetic Ether, for example, and you can cross those two curve pools. So, Curve has very, very deep liquidity, right?
Yeah.
But it doesn't have liquidity across different curve pools. So basically the synths act as like a bridge between them, and then 1inch routes and finds the cheapest route between all these different curve pools to fill the transaction.
And all of that's happening in a single transaction, all those DeFi Lego.
Yeah, exactly.
Awesome.
So composability at its finest.
So the atomic sense, were you guys doing this before and it took longer, or?
We were doing it before and it required like a multi-step transaction. And the reason for that is a whole bunch of things, but basically there's protection mechanisms built into the Synthetix protocol to ensure that the Oracle latency is not front run, so that people don't take advantage of Oracle latency.
Oh, some front run protection there.
Yes.
Okay.
Yeah. And so what that basically does is puts a speed bump in, but what we've been able to do for these specific transactions is remove that, so that now you can actually do in a single transaction the entire flow of the transaction, from an off-chain trade through to the USDC to SUSD to SBTC to wrap Bitcoin, and then on all the way through.
And so have you seen the volumes change at all since you added this atomic functionality, or?
Yeah, so 1inch did the router integration, I think maybe a couple weeks ago, and since then a number of bots have started integrating it, and obviously it's integrated in the front end as well, so end users are using it to get the best fill, but since then volumes have been on a daily basis up probably like 10 to 15 fold.
Fold.
Yeah.
Wow.
Yeah,
okay.
Yeah. So going from like low to high single digit millions to like up to 250 mil in a couple of over a couple of days.
Wow, that's awesome.
Yeah. So it's been a huge increase, and I mean, to be honest, there's still a lot of opportunity, because on the Curve side, on the Synthetix side, there's still some optimizations to be done, and probably, knowing Anton, maybe even some optimizations in the router as well. So.
Yeah, you said the Optimism side there. Did you say that earlier?
Oh, sorry.
Oh, sorry.
Optimizations, as in.
Optimization. Okay, I got layer 2s on the mind.
No, we're not. So this is the other interesting thing, is this is all happening on L1 right now.
Okay.
So obviously Synthetix is on Optimism as well as L1, but these are layer 1 Ethereum mainnet volumes that are happening within the Curve pools and all this stuff there.
I kind of want to touch on that subject. Are you guys working in parallel there on L1 and L2? What are you doing on L2 Optimism versus L1? Are you only on Optimism layer 2?
Yeah, so we're on both Ethereum mainnet, so L1 and Optimism.
Okay.
But we have kind of a unique approach to that, where the protocol is actually merged across those two chains. So we use Chainlink to basically keep the entire protocol in sync across both chains, which is unusual. Most of the time when you see a protocol deploying multi-chain, they'll just fork
Totally
the protocol
siloed,
and
usually.
it's siloed, whereas we actually have like unified liquidity across both.
I guess that's kind of a unique thing with like proper layer 2s like Optimism. They share layer 1 Ethereum security, right?
Exactly.
That's how they work. So you don't have to worry about layer 1 Ethereum, I don't know, security breach there or something like that, and that breaking the other side, or vice versa.
Yeah, exactly. You know, like if you're using L2s, obviously you've got, you know, EVM equivalents, so there's a bunch of benefits to that. But even still, the effort to kind of keep those networks in sync is, you know, not trivial. It takes a bit of work. So it's taken a bit of time to kind of get to that point where both networks are in sync. But now that they are, eventually these atomic swaps will probably be cross-chain as well.
Wow.
And so what you'll have is like an arbitrage opportunity where there's a large trade on Optimism and the price, you know, is kind of deviating from whatever the price is on L1, and someone will be able to go and basically route a trade through a bridge over to L1 to arbitrage that.
Cool.
Yeah.
Why Optimism also as a layer 2? I've heard of, I mean, we have a lot of scaling solutions now. You have all the way from EVM compatible chains that are completely separate from Ethereum to side chains to roll-ups. What's the difference between those things? I mean,
basically
they're all Ethereum, right?
Trade-offs. Well, yeah, ish, I guess, right?
I guess
like,
EVM.
So, you know, there's a range of different solutions. So like one of the first solutions out there was XDAI, which is basically a sidechain, right? And then Polygon, which started off as basically a sidechain, but it's kind of moving in the direction of being like maybe a ZK rollup or something like that, but at the moment it's kind of more like a sidechain. And so you've got different security trade-offs there. You've also got different usability trade-offs as well. So there's also Starkware, which runs as like its own kind of zero-knowledge based scaling solution.
And it's not,
but you're kind of siloed in Starkware.
That one's not even EVM, right? I think
No,
they're doing
Cairo,
but it's still,
Exactly, yeah. So that's another trade-off. So you've got a separate code base, and you've got to write, you know, fraud proofs and all that sort of stuff. So.
Cool. Yeah. You've had a good experience though, moving over to, or some of your volume over to Optimism.
Yeah, I think we're about 30 or 40% of the network is now staked on Optimism.
Really?
Yeah. So you know we've kind of migrated a big chunk of the liquidity across. Obviously, you know, it's hard to bootstrap a new network, and so you know. Curve is now on Optimism, you know, 1inch is on Optimism, but these things take a bit of time.
Even just bridging tokens over.
Even bridging tokens, And I mean, look, realistically, I would say, to me, using Optimism feels like mid-2019 L1.
That's how I kind of felt when I was toying around on there.
Just in terms of like efficiency of the market and everything, right?
Yeah, smaller
but it's
trades.
getting better. Yeah, like there's just not as much liquidity. There's you know, arbitrage bots are a bit slower, but it is getting better on like a day-by-day basis.
But also at the plus side of mid-2019, like sub-dollar trades, which is really cool.
Exactly.
Yeah.
Exactly. Yeah.
Awesome. Yeah. So just crypto in general. Obviously in a bear market right now, but at the same time I'm hearing stuff is happening on your side, right? You hit all-time high volumes on that.
On the cross-asset swaps, as well as, you know, we have perpetuals running on Optimism as well. So the perpetual volume, you know, on Optimism has been like $10 to $20 million a day. So on both sides, both networks, you know, there's new stuff that's starting to grow, which is really, you know, it's positive.
Cool. How do you see these market conditions impacting the crypto space as a whole?
Obviously, you know, when there's a market downturn, you know, you lose a bit of liquidity. You know, the market becomes a little bit more fragile. For a network like Synthetix, that creates some issues. You know, because we leverage the fact that the collateral is what kind of begets liquidity. So if the collateral value goes down, you've got, you know, less synths around, which means less trading volume.
Yeah, I guess
you know, it's the same as an exchange basically. That said, you know, bear markets tend to be very volatile as well, which is good for, you know, trading volume. So there's kind of, you know, there's some trade-offs there. I think probably the best part of a bear market though is it forces everyone to slow down. You know,
Yeah.
in a bull market, there's just a million things happening every day. It's really hard to get people to pay attention to things.
Yeah.
You know, people's attention is very, you know,
Watching the
fragmented.
charts
And
often.
exactly, yeah. And so, you know, once you get into an environment where things are slowing down, people can kind of take a look around and see what's happened over the last, you know, 12 to 18 months. And I think we're seeing that now. And the response is, you know, people realizing that things like Aave and, you know, Synthetix and some of these projects have been continuing to make progress over the last, you know, few years, even if, you know, people were running around chasing stuff on Avalanche or Solana or wherever.
Yeah, yeah. I guess this bear market, some would say, is kind of different than previous ones. You said you were around for the 2018 bear market.
Yeah, yeah.
The argument they're making is that there's kind of a macroeconomic downturn right now. Do you see this one as being different at all in that sense, or?
Yeah, I actually just published a blog post that, you know, kind of touched on this a little bit, right?
Okay.
You know, for the last, 15 years, we've had pretty loose monetary policy around the world, right? You know, continuing low interest rates, et cetera, right? Especially post-COVID. There are probably 3 times in the last decade or so, like in the, you know, kind of history of crypto, where monetary policies tightened, which is 2013, 2018, and now. And in all 3 of those cases, you know, the crypto market has taken a hit. And at the moment, I think we're just in a risk-off environment. So as much as you know, the Bitcoin maxis wanted to think that Bitcoin was going to be, you know, a hedge against inflation or all kinds of things, the reality is it's still a very speculative asset, and that's just, you know, created a bit of short-term pain. The real question, I guess, is like, when do macro conditions shift, right?
Yeah.
And I don't think anyone really even knows. You know, certainly even the central bankers don't really know.
I guess that whole hedge against inflation thing really got put to the test in the last 2.5 years, and I'm not really seeing much coming from it. I mean, early COVID, I guess early 2021, Bitcoin was near all-time high, around 60,000. I think inflation, official CPI was like 1%.
Yeah.
Now we're sitting at 20K Bitcoin, where CPI is at close to 9.
Looks like a risk-on asset.
Yeah.
Yeah.
It's like there's some stuff we're not accounting for in that model.
For sure. Definitely. Yeah.
Cool. I guess this whole bear market, if you want to call it that, was kind of kicked off with the whole Terra Luna crash. Stablecoins are a hot topic right now. The whole algorithmic stablecoins versus collateral-backed stablecoins. I know Synthetix has its own stablecoin. Do you want to touch on that subject at all? What's the difference between those two things? Like, what's an algorithm? Is Synthetix an algorithmic stablecoin, or is it collateral-backed?
I mean, it's kind of both. It's a
like DAI is kind of both.
Yeah,
right?
it's kind of like there's mechanisms. You know, fundamentally, it's an over-collateralized stablecoin.
Okay,
right? You got a
over-collateralized is the key word there.
Over-collateralized is the key word, right? So that's the fundamental mechanism, and then you have a whole bunch of other mechanisms overlaid on top of that to try and maintain stability, right?
Like the liquidations you talked
liquidations,
about. I mean, they suck, but
liquidations,
I mean,
incentives, you know, claim windows for us. So you've got to claim periodically. You need to be above the collateralization ratio target to be able to claim. So there's all of these.
That's to claim rewards.
To be able to claim rewards.
Okay.
Yeah. So your fees that you earn from staking, and so there's all of these mechanisms that are kind of there to ensure that the fundamental stability, which is over collateralization, you know, it remains solvent, basically, right?
Okay.
In terms of, I guess, you know, some of the maybe pure algorithmic stablecoins, you know, things like Ohm and some, you know, the other crazy things that have been tried in the last couple of years. I think, you know, we've obviously seen that in volatile times, you know, they don't necessarily hold up that well. So, you know, I guess my perspective is probably you don't really know you're in a bear market until you kind of look back, right? Like you can't really, it requires like a little bit of hindsight. And so I think the reality is we've been in a bear market now for, probably almost 9 months. And, we were maybe 3, 4, 5 months into it when there was enough pressure on Luna for, it to blow up. Right?
Oh, that's a good point.
In a bull market, it's fine. Everything's going up, no big deal. As soon as there's a bit of pressure, that's when the equilibrium can shift, and algo stablecoins can struggle a little bit.
Cool. Do you see some regulations coming down on crypto because of the whole, I guess, stablecoin blow up we saw happen a couple months ago? Is there any good that can come from regulations, maybe? Well, what's your take on that?
I think, regulators have been trying to work out what their approach to crypto is going to be for a while.
Yeah.
There's obviously a bunch of different regulatory bodies all around the world. Even within the US, there's different regulators with different mandates. It's hard to get, I guess, a cohesive sense of what the regulatory approach is. In Australia, I think a lot of people have commented recently on the fact that it seems like there's a lot of innovation coming from Australia, right? There's a bunch of projects that have done really well in the last couple of years. And I think one of the reasons for that is that the regulators in Australia have been fairly permissive. They've been fairly hands-off. The assumption has kind of been if you're a good actor and you're well-intentioned, then you kind of have a little bit of leeway to experiment, right, and innovate. If you're obviously doing things that are fraudulent, or there's been a bunch of scams and things like that, the regulators have gone after really aggressively. But for the genuine like innovative projects, they've been pretty permissive, which is I think the result of that we're now seeing a couple of years later, where there's a whole bunch of people that are doing really cool stuff.
Yeah, maybe U.S. regulators can learn a thing or two from Australian ones. So.
Maybe.
Yeah. What does mass adoption look like to you? I mean, are we there yet? Or
no, we're
not close.
We're not even close. The reality is we just don't have the scaling even today.
So it comes down to scaling for you.
So.
Any UX issues there also, or?
I mean, there's definitely UX issues, but cost of transaction is probably the hardest limiting factor.
I guess you guys were really early movers on the layer 2, right? Were you probably the first major project on using a proper layer 2 with Optimism?
We were. Or? Yeah, we kind of leaned into the Optimism scaling solution early, and the reason
what
why.
What year was that?
So this is started going back, I guess, to like 2020.
Okay.
So the reason why we did that though is because Synthetix has always been a very expensive protocol. Which is actually interesting because one of the reasons why we have such a good relationship with the 1inch team is Anton back in the day actually did some gas optimizations on the Synthetix contracts for us, and was able to reduce the cost of a bunch of our transactions. I think this is going back to like mid 2019 or something like that. But because we've always been expensive, as gas prices have gone up, as claims have gone up, we also force you to claim every week. There's just been this forcing function where a lot of users have
get priced out.
Yeah,
they couldn't even claim the rewards.
Exactly. Yeah. So it got to a point, I think, by the time we were in DeFi summer, you needed maybe $10,000 or $15,000 to be able to justify actually staking, right? So it really priced out a lot of people, and that just forced our hand to look at what was the scaling solution going to be, in a way that I think some of the other projects were able to go a little bit slower. So we had to kind of go all in and make a call.
So have we solved scalability yet with the layer 2s, or are they kind of iterative? I know even Optimism, they're still pushing through gas optimization things right now, right?
We're not done. There's no question.
Okay.
Obviously we've got the merge coming up. This idea of like a roll-up centric, roadmap for Ethereum. That's still in progress, right? And the roll-ups themselves have a lot of optimizations that we can squeeze out. And then we all need to kind of work out what does like this multi-roll-up post-merge, sharding kind of
goes back to what you said about like the cross-chain atomic swaps and stuff, right?
Yeah,
because
exactly.
if I'm trading on, let's say, Starknet, and I want to tap into some liquidity on Optimism, I don't want to make 2 layer 1 transactions in order to do that.
You
that
want
defeats
a direct
the purpose.
bridge. Exactly.
Yeah.
So again, we just need to work out what does that ecosystem look like, with multiple different roll-ups, different roll-up types, and then ideally using L1 as like a settlement layer.
Yeah. Cool. Any silver lining coming out of the bear market? What do you think?
Yeah, I think, again, it allows people to stop and look around at what has been built. So, I've had some amazing conversations in the last couple of months with people where you're sharing stories of like some new protocol or some mechanism design, and they've never heard of it because there's just too much noise, right?
Yeah.
And so I think the beauty of Ethereum and the beauty of DeFi is really in composability. Right,
yeah.
So even these cross-asset swaps that we've just been able to deliver, atomic swaps, it requires 3 or 4 protocols, right, to interact together seamlessly in order for that to work. There's been a ton of innovation, but not as much composability over the last 12 to 18 months. I think now in the next 6 to 12 months, we'll see a lot more solutions that are based on composability and combining different protocols. We also have a bunch of improvements to governance that need to be rolled out. Unfortunately, in a bull market, governance doesn't pay. You want to do whatever the most expedient thing is.
The whole DeFi 2.0 thing, we kind of saw.
There's a lot of shortcuts and stuff that people take, right? And it makes sense because in a bull market, you're trying to get to market as fast as possible. You want to, you've got your foot on the gas and trying to, go as quickly as you can, which means things like good governance just get thrown out the window. In a bear market, those kinds of decisions get revealed, because there's much more scrutiny on the projects that are around, right? And so I think that improvements to governance, improvements to scaling, there's going to be a whole bunch of things that come out of the next 6 to 12 months, depending on how long this bear market lasts. But bear markets are always where the good stuff happens.
Yeah, I guess kind of to wrap up, just if you had to choose one thing you're most excited for in the next, in the bear market, next 1 year, hopefully it's only 1 year.
Yeah.
What would you choose?
Synthetix v3, for sure. So, Synthetix has been around now in its current iteration since December of 2018.
Okay.
Right? So it's going on almost 4 years, this code base. There, I think, have been 50 plus upgrades. Synthetix v3 is a complete from the ground up rewrite. Fresh code base, fresh architecture, a whole bunch of changes to the mechanism design, efficiency improvements. So the existing Synthetix that is on mainnet right now, while it's functional, is much more complex than it needs to be. And so Synthetix v3 will really streamline a lot of the functionality and make it easier to use, much more efficient, cheaper, etc.
Awesome.
Yeah.
Cool.
Yeah.
Well, thank you so much for taking
my
the time.
pleasure.
Yeah.
Yeah.
Great conversation.